Now we learn what depreciation is, we need to look at how we calculate it. So we're going to start with something called straight line depreciation. So basically in our course there's two methods of depreciation we will have to calculate. Straight line depreciation and reducing balance depreciation. So we're going to park this one for a bit. We'll cover that in the next part of the course. So for now, for the next little bit, we're just going to talk about this method here called straight line depreciation. So what does that mean? Well, it means that we allocate the same amount of depreciation each period. So let's take this example here. Say we've got a non-current asset, we're going to use it for 4 years. We would charge the exact same amount of depreciation each period. So we've got $10,000 depreciation expense in year 1, $10,000 in year 2, $10,000 in year 3, $10,000 in year 4. And that's what straight line depreciation is. It's going to charge the same amount of depreciation each period. So basically what it assumes, therefore, is that the non-current asset we are depreciating will generate the same amount of revenues each period. It's going to be as efficient at generating revenues in year 1 as it is in year 4. So therefore it will probably make roughly about the same net profit every year too. So what we want to do, and we'll get into this more when we do reducing balance, is say, well, when will we use straight line? So we'll say it's a really good option for non-current assets that do not deteriorate, break down, require maintenance, or become less efficient over time. They're going to earn the same amount of revenues every year because they're just as efficient in the last year as they are in the first year. So what sort of assets will we be talking about? Well, sort of inanimate objects like a desk, or a chair, a display stand, a refrigerated little thing here. They're as efficient in year 1 as they are in year 4, 5, 7, or 10. So that makes sense. So straight line depreciation is going to be good for non-current assets that don't break down or get less efficient, don't need to be maintained very much or at all. So therefore it's not going to be good for assets that do deteriorate, that do break down, that do need maintenance and do become less efficient over time. So take a vehicle, a computer, machinery, a mobile phone, all of those things, they get a little bit less efficient every year and a little bit more goes wrong with them, so they're not as good at earning revenue. So we would expect with these things here that the revenue earned in the final year would probably be a bit less than in the first year. But that is actually something we're going to deal with when we do reducing balance depreciation. So for now, we're just going to focus on these types of assets here. Non-current assets that don't deteriorate or break down, and they have the same amount of efficiency over their whole life. So the revenue earned in year 1 is the same as in the last year. So therefore, we're going to charge the same amount of depreciation expense each year. And that whole process is called straight line depreciation.